Hi, welcome to the cash flow machine chart reading system. And if you're going to be a good trader, you've got to be a good chart reader. I've literally read probably a million charts in my life for sure. I read hundreds during the week, if not thousands during the week, depending on the week. And so the reason I'm telling you this is because you got to get good at this, because you've got to get good at pattern recognition. Our brains are set up to recognize patterns. And that goes way, way, way back to our ancestors who were just trying to stay alive. And there was a saber-toothed tiger behind the tree, and they recognized that pattern because they learned that pattern, and those are the ones that are alive. And now we're still here today with that same pattern recognition skill. So we might as well use it to our advantage. So let's start learning about reading charts, because reading charts is very critical. It's one of the things that a lot of people like that I do, but I'm not anything special. I just have learned how to do it, and I've read hundreds, thousands of charts. And you can do the same thing. Just start. Look at 20 charts a day. That's 100 charts a week. And your brain's going to start figuring out the patterns. We're going to be talking about that. In fact, here's what we're going to be talking about in this whole module. Early stage bases, late stage bases, cup and handles, double bottoms, cups without handles, consolidations, flat bases. So we're going to start talking a lot about base patterns. I can't make this video that long though, because I'll kill you if I just spend as much time as reading one chart as I do normally in my day-to-day life. So I have to kind of whip through this, so I apologize for that. I'm going to give you an opportunity to learn more, obviously, but I want to try to give you as much as I can in this module so that you can take it away and start to apply it right now. So we're also going to talk about technical analysis. I mean, chart reading overall is technical analysis, but the ones I use, the key analysis factors that I use are resistance lines, support lines, the 50-day, the 200-day simple moving averages, the 8 and the 21 exponential moving averages, and then we're going to talk about probability, market timing, and sectors. So let's get going on this. If you want to be a consistently good trader, you must be a chart master. So don't dismiss this as adult voodoo or tarot reading, because what it is, according to one of my distant mentors, William O'Neill, he basically said chart reading, a chart is like watching emotion on parade. And so what we're looking at is we're looking for the big footprints. The big footprints is the big money. The big money is the institutions, the market makers, the big money, the billions of dollars that are moving around every day. It's not you and me, but they are chart masters too. If you want to learn more, I've got obviously courses that you can learn more, but I'm going to try to cover as many things as I can in this. Trade Like a Pro is my chart reading course. Breakout Mastery is basically taking everything that I've learned, putting it into a full system. And I'll tell you where all this came from. This came from investors.com, which was started by William O'Neill, who's a very detailed researcher and came up with an incredible system. And then I built on top of that. Now, I'm going to say that 90% of this stuff came from William O'Neill and Jack Schwager and Tom O'Brien and John Bollinger and a lot of the other greats that came. So I'm just taking it and distilling it for you so that you can learn how to do this. And then I tack on options and option strategies on top of it to build cash flow. So that's where this came from and where it kind of is going. But I want you to get this knowledge now. So let's go. Analysis paralysis means you probably have too many indicators. So if you're wearing the MACD on your chart and the Bollinger Band and the stochastics, and you've got the moving averages and you've got the detrended price oscillators, use Fibonacci's, and you put all this stuff on there, chances are you won't make any decisions. So the idea is to kind of balance too many market timing indicators or market indicators or technical analysis factors, studies, with too few. So too few is going to not really give you an idea of where trends are. And we're trying to get probabilities in our favor. And that to me is finding where the trends are. And so the goal is here to get you to understand and recognize pattern recognition again, where the trends are. So let's rock and roll. The first thing you have to do is understand what base patterns are. And I'm just going to describe it to you. Imagine a staircase, okay? And you take a couple of steps up and then maybe a step back, but you take a few more steps up and then maybe a little step back, and you take 5 steps up and maybe 1 step back, and maybe you take 4 steps back and then you take another 7 steps up. You get the idea, right? So we're stair stepping, okay? That's a pattern, the stair step pattern. It's a pattern actually, if you want to find out the origins of where I get it, it's from Nicholas Darvis, who wrote a book, How I Made $2 Million in the Stock Market back in the 50s. Great book, but he talked about the Darvis box theory. It's basically stair steps. So that's one pattern. But what happens is each step is a base. Okay, so you're going to hear me talking about bases a lot. Now, what you want to do is you want to get the probabilities on your side. You're going to hear that word a lot. What that means is you need to buy when it's the best chance of you succeeding. And I like stocks to go higher, right? We don't like stocks to go lower and try to pick the bottom. We're not value investors, at least I'm not. I like stocks to go higher. What does that mean? It means I need to understand how they go higher and figure out what basis they go in. Okay, what that means is I want to be early to the game. Imagine buying Apple in 2003, Amazon in 2009, Nvidia back in, 2000, whatever. Like, you want to be early, because if you're early in all these stocks, you make the big money. Now, we also layer on top cash flow along the way, but the point is that you want to be early. So I talk about early stage bases. So bases are little patterns where things set up in a consolidation and then they break out and they go higher. You know what I'm talking about. I'm going to show you a chart in a second. Early stage bases are early because they have the highest probability of success. If you're along the ride early in the base count, you're going to have a much bigger chance of being successful. And so that's what the big market makers do. They find a stock, they see the value in it, they start to pile in it, they tell their buddies at the at the happy hour what they're doing, and they all pile in it and they jump up and make the stock go higher. And you can do that too. You just got to know where they're doing it. And that's all in chart reading. Okay? That's why we're doing this. We want probabilities to be in our favor, and this is important. So what are some key base types? I'm going to go into this. I'm going to show you some actual charts in a second. We're going to show you cup and handles, double bottoms, cups without handles, flat bases, and consolidation. Look, at the end of the day, as I teach in my course, everything is a consolidation. Everything is an area on the chart where the buyers and the sellers are trying to fight it out. It's psychology, it's greed, it's fear, it's hope, all stuck in this little area, right? When a stock is ready to break out, and it's gotten rid of some of the resistance, some of the sellers, some of the people that are holding it back. The emotions are now to the upside. The buyers are in charge, and we want to know when that happens. The same thing happens on the other side. So let's talk about those patterns. Let's go back to Apple of 2015, okay? This is a really good thing to study, and I use a program that's put out by investors.com, Investors Business Daily, William O'Neill's outfit, and it's called Market Search. You don't need this software, right? It's just helpful. And I'm going to discern what it does so that you can understand what it does. And these are bases. So you can see it already draws the bases out. It's got pattern recognition built in. I don't need this. I use it so that I can teach, but I usually take it off and I find my own patterns on the chart. And most of the time they lined up with the computerized patterns that you see on this chart. But I want to show you this base count. Let's go to 2014 here. Now, I want to show you what Apple did. So Apple has this base count here. You can see that this is a late stage base. Now, I'll be talking about this exact chart in a moment, but you can see this base went up and it failed. Now, we're going to talk about what happens. Bases fail, and when they fail, you've got to recognize them, and you've got to also not buy late stage bases. This is a 7. It's one of the fewest, you'll never see 7s. And I rarely see a 7. I want to show it to you because a late stage base has the potential of correcting. So look at what it did. It went from, let's call it 26 all the way down to 12, got cut in half because it was a late stage base, and late stage bases just are prone to failure because they run out of buyers. Now, what happened? It set up a first stage base right in here. You can see a little flat base. A little flat base is a short consolidation. So here's the base at $21, and you can see it went from $21 to $29. That's a 50% return. Then on top of that, it built another base. So that's a secondary base on base. So this is a stage 1. See where it says stage 1 there? And then it goes to a stage 2. Why does it go to a stage 2? And I'm sorry, but I have to go really fast. It goes to a stage 2 because it's gone up more than 20 to 25%. That's where traditionally and historically and philosophically and probabilistically most people take their profits, is at 20 to 25%. Hey, honey, I just made 25%. And she or he says, okay, let's get out. That's a good number. Problem is, you don't get to make these big runs when you get out. But that's where traditionally people get out, and you should consider it. But sometimes the base doesn't go up 20 to 25%, so you get what's called a base on base pattern. And so you have base 2A and then 2B. And so that all leads to another base. And so here's a breakout on the base. I'll talk about volume breakouts in just a second, but you can see this is a nice base, and its stock went up here, and it created a third stage base. After stage 3, we're now getting into late stage bases. You want to buy 1s and 2s, 3s maybe, but you're starting to get into the risk area buying late stage bases. So you can see a consolidation. It's a very short, this is a weekly chart, by the way. And then you could see a double bottom pattern, okay? So double bottom, you see the 2 V's there. I'll talk about that in a second. In fact, I'll talk about it now. So remember what I said. Patterns are consolidations. They're levels where the buyers and sellers are fighting it out. And so you can see there's a flat base, which is just a short consolidation. Another flat base is a short consolidation. This flat base here is a short consolidation. Then we have a double bottom. The double bottom is basically 2 V's, with the second V being slightly lower than the first V. The buy point on a double bottom is the top where the V's meet together, okay? And then so the other side of that is your buy point. They call that the pivot point. And you could see on that, the pivot is $38, right? So I like to go a dime above the $38. It's just how I was trained. And then so you see this little consolidation is set up. On a consolidation, the top of the consolidation is the pivot point. On a double bottom, the top of the V's where they come together is the pivot point. Now we have a longer flat base here, right? So fairly good base here. But notice it's a stage 4. And stage 4s are risky, right? Notice that this one worked though. So we got a stage 4 and a 4B because it didn't go up 20 to 25%. Sorry, I'm going fast. That's the way it's got to be. And then we go to a 4C because it didn't go up to 20 to 25%. See the stair steps? Step 1, step 2. But in the stair steps, you're seeing movement up and down. Like this isn't guaranteed that it goes higher. We're just trying to catch the base, the breakouts, right? So now this is a big, long 4-stage base. Remember when I say this, the longer the base, the higher the spring. So it's like coiling a spring when it stays in a base. And we got base on base on base. That's basically like a coiled spring going on. And then look at it. It springs higher from the pivot of 61 all the way up to almost $100, right around $100. And now notice that this is a 5th stage base. It's the 9th base in the series. Notice the 5, 9. But also notice what happens. Remember, the later the stage base, the higher the probability of failure. And so look at this thing. It goes all the way up here and it fails. Now it fails at 100 and goes all the way down to like 55. That's a big number to sit through, a 45% correction. Pretty big number to sit through. And when a base undercuts the prior base, it resets the base count. So look at this very long, 65-week long cup. So all of these people that had made all this money were selling up in here. That's why it's so long. It couldn't make the other side of the base. And so it made a cup with a handle, and now you see the pattern start to repeat as long as the company continues to repeat. By the way, I'm not talking about fundamentals in this video. This is just chart reading. I've already done the fundamental work to get to the point where I'm reading the chart. Okay? So you've got to look at that. All right. So that's the Apple base. So I've talked about a cup and handle. That's this base here. This is another small cup and handle as well. We've got a cup without a handle. By the way, a cup and handle, the top of the handle is where the breakout is. So here's the top of the handle. Notice it's a lot lower than this top of the cup, right? If you had to wait for that, you'd wait all the way till here to catch your breakout. But the handle is where a lot of people that made their money on the way up, they were the people that said, you know what, if this, I've sat through all this, if this thing just gets up to this price, I'm going to sell. And so those are the sellers in here. And usually the volume dries up in the handle. And then you want to buy the top of that handle because you get the highest probability of a breakout when you buy at the pivot. Okay, so we've talked about cups, cups and handles, cups without handles, double bottoms, flat bases, and consolidation areas, all on this one chart, right? Pretty cool. All right, let's go back here. Now, what are support, resistance, and key price levels? Well, I'm going to use that same chart, except I'm going to put it on a daily. So now I'm going to put it on a daily, and I want to show you what I'm looking at. So on the chart, you have this black line. That's the 200-day moving average, okay? On the red line, it's a 50-day moving average. These are simple moving averages. I also, and they're a little hard to see on this chart, I also have this green line, which is the 8-day exponential moving average, and the 21-day exponential moving average, okay? Those I find are two critical moving averages. They're both Fibonacci numbers for those of you who like voodoo. And so they are highly indicative of short-term moves to me. So you can see that those are the four moving averages I have on here. Now, I also want to draw some lines. So you'll notice that this 103.74 is the top of a consolidation or a flat base, but it's also an area of resistance, okay? So you know what I mean when I say resistance. There's a resistance there. But if I do this enough, my hand's going to start to hurt and it has to get out of the way, and then my momentum goes forward. Same thing with the resistance line. Notice this resistance line there, and it basically was a bounce point. Look at it, 1, 2, basically 3, 4 bounce points where it couldn't get through, but all of a sudden it got through. Now, I want you to notice the volume when it starts to get up toward that resistance. There was a gap up here, okay? Notice the volume is 27% higher than normal. That's okay. Then we had that gap up 52% higher than normal. The next day we come right into that resistance level, that spot. We hit the top of the consolidation or the flat base there. We're only 9% above average volume. So it doesn't have a huge amount of momentum. That's why it came down that day. Notice how it closed below resistance. But the next day it came up the other side and tried it again. And now it's 12% above volume, which is still not great. But look at this chart. It just keeps going up and up and up and up and up and up. Now, that's not textbook, right? What you want is you want volume coming out that's very, very high. So look at this cup and handle. Notice the resistance here, okay? If I draw the top of that handle, it's right about there. And I want you to notice we have a gap up on volume here, okay? A follow-through on high volume. Any volume is higher than the 50-day moving average of volume. And then a third day of high volume. So this has got 3 days of high volume following a gap away or a gap up, and now it's gapping above its all-time high, or at least it's high on this chart. Not its all-time high for sure. And then it kind of settles down on lower volume, but that key is telling you that the market makers are coming in to buy this, and they want to drive it higher. So that's a resistance level. At the same time, you have a support level. So notice there's a support level right here, okay, at 96.14. Actually, it's about 95.18. It redrew it later. Can't draw this line for some reason. Anyway, it's right there. You can see the line, right? Right there about 95.18, something like that. And notice how it goes down there and it bounces from there. That's a support level. Now, when it does it more than once or twice, you get a major support level. Right there is just a bounce, right? It's not really a good example of a support level, but as I do more charts, you'll see this, okay? So we've got this, it hit the support level and it bounced up. It went above the 50-day moving average and it continued to bounce up, okay? And then that's when it took off. So you're going to be able to use these horizontal lines. That's probably 60% of your support and resistance lines, okay? But then you also have trend lines. So let's look at this trend here. I'm just going to advance one day to wipe those away. And I want to show you how these trend lines work. Look at that trend line, kind of touching 2 or 3 spots. And you can see that stock is now trending up, okay? There's another one right here. If I draw like that way, it's now basically pushing a trend slightly down. This one's got a higher angle than this one, so it's basically wanting to go higher. When you draw parallel lines, now you get a channel, okay? Now, this is a little bit, you're making things kind of bend to your wishes, but I want to show you that these lines are support lines. So notice when it broke above this resistance line, that line turned into a support line, and now it's broken through, okay? So when you're drawing lines on the chart, make sure you have 2 or 3 spots because they're kind of self-fulfilling prophecies by the big money. Oh my gosh, if it falls within this channel, let's sell it. And when it goes back up at the bottom of the channel, let's buy it, things like that. Little self-fulfilling prophecies that are going on all the time without our knowledge because there's collusion in the stock market and you and I are not part of the club. All right, so I've talked about resistance lines, support lines, and volume confirmation around breakouts. And I'm going to show you this a little bit more. Moving averages, 50-day 200. You want to put those on your chart. You want to put the 8 and 21 EMAs on there. And you want to start studying how they act as support or resistance during the patterns. Okay. Now, when you get a bunch of moving averages moving in the same direction, you're getting a lot of confirmation. Confirmation increases your probabilities. Now, probabilities is what we're after here. Nobody knows what the market's going to do. I don't know. You don't know. Even the market makers don't really know for sure. They collude and they kind of know, but 40% of all breakouts are going to fail. And so that means 60% of them are going to succeed. That's pretty good because when you click a mouse to buy a stock, you got a 50% chance of being right and a 50% chance of being wrong. But if you can start to get the probabilities in your favor by using breakout trading, then you get those probabilities stacking, right? Now, it doesn't guarantee it. Only 40%, so only 60% work, but 40% of them fail. And sometimes they take another shot at it or a third shot at it because the market makers are now banging into that resistance and trying to get through that and make a level where they can build that step from there, okay? So what affects probability? Well, you've got the base stage, whether it's early or late, I've talked about that. Volume on the breakout. We want to have at least 40% of the average daily volume on our breakout candle. You want general market conditions to be moving in your favor. Market timing matters for sure. And then you want the sector, right? 32% of a stock's performance comes from the performance of a sector, right? Of its industry. All the chip stocks are moving up. Chances are if you're in the top 1 or 2 of those chip stocks, you're doing really well. The same thing happens on the other side when things are going down. So you want to be out of those weak sectors and in those strong sectors because all of these things stack the probabilities in your favor. And I want to say that risk management is critical. Like just because you get all these things lined up and you have the right spot on the chart and everything's perfect, doesn't mean you're going to be successful. You've got to have good risk management backing this all up. Okay. Now, market timing is important. I'm not going to this is not a market timing video, but 70% of a stock's direction comes from the direction of a market. It's a stock market, a market of stocks. So chances are your stock is probably being swept up with the market direction. And then you want to have your tools, not necessarily my tools, but I like to use the 50-day moving average. If a stock is above its 50, it's probably doing well. If it's below its 50, it's probably either in trouble, about to be in trouble, or it's not doing well. So, have that in your quiver, that arrow in your quiver, because if a bunch of stocks are not doing well, they're below their 50-day moving average, chances are the market's not doing well either. Also, sector rotation is important. Remember, strong setups in weak sectors can still have a higher probability of failing. So you want that sector to be working in your favor. So sector ETFs, the CHIP ETF, Exchange Traded Fund, or the Pharmaceutical Exchange Traded Fund, if they're doing well, chances are the stocks that make up those ETFs are doing well as well. So relative strength is important. How well is your stock doing compared to the market? That's important as well. And use those IBD ratings. I think you can get them for free on investors.com as long as I'm recording this. I know it's still valid. So use those tools. They're really good. Let's go through some chart reading as I have just a few minutes left to do this video. And I might have to break this into part 1 and part 2. But I want to show you what I do when I read a chart. And I want to emphasize first that I talk through out loud my chart because my brain is listening to my voice. And if I can just say a lot of things, a lot of data points, my brain is making a picture unconsciously of what that looks like. And maybe, I don't like to say this, but what it feels like. And so I want you to do this the same way that I do. And that's opening up a chart and starting to read the chart out loud to yourself, to the mirror, to the dog, to your girlfriend, whatever. Read it out loud because you're going to paint that picture in your brain. So I'm going to pick a chart and then we're going to go through that. Okay, I'm going to start by reading the chart on Nvidia, okay?
This content is for educational purposes only and is not financial advice.
Nothing here is advice about what to buy or sell. This is strictly chart reading education. And this is a chart that I pulled up. Now, this is going back many years. It's almost a 10-year-old chart. And so Nvidia's had several periods of time where it's gone up. So I want to give you that idea first that, we started here in a stage 1, then we went to a stage 2, a stage 3, a base on base, stage 3B, and then we reset the base. Notice how it's a late stage base or a later stage 3 and higher are later stage bases, and it reset. And then now we have a 1, a 2, a base on base, and then we go up to 36%, and we came down the other side in 2022, which was a bear market anyway, so everything kind of came down the other side. And then we started with another 1. Notice how this is over a period of time of 9-10 years here. 1, way up. Look at the price. It goes from 18 all the way up here to $47, and we got a double bottom. Notice the double bottom. Stage 2 base on base, so stage 2A and B, up 24% within a few weeks, and then we go to stage 3. Now it's starting to get a little risky, but it still did pretty well. Went to a stage 4. And notice stage 4B had a failure, okay? So we tried to break out of that cup, and then we had a failure on the other side, and now we consolidated, and now we're starting to go up the other side of that. So that's a resetting of the base because it undercut the prior base. Consolidation number 1. Stage 2, because it's up more than 20 to 25%. You get the idea. This is a current chart as I record this today on Nvidia. You get it, right? So that's how I read it. How would I read the chart right now? Well, let's go through it. Now, I got the trend. I know it's lower left to upper right, but let's talk about it. So we have our consolidation. That means this is a stage 2 base, okay? Now, there's a lot of noise on this chart. What do I mean by a lot of noise? Well, let's just look at the base, okay? So we had a nice high being made here at 184.48. Then we tried to break it again, and it couldn't break, right? Not that it was a proper base, but it couldn't break. So that set the top side, the resistance side of this chart, okay? We went down. We didn't quite touch the 50-day moving average. We just went down and popped back up. And then we went down and gapped down below the 50-day moving average. Now, let's look at the volume on the gap down. That's pretty heavy volume on these couple of days where the stock is going down. Notice also, I'm just going to throw this out there, that the 8 is crossing down through the 21-day moving average here. And that doesn't always work, but in the short term, it's showing you that there's weakness in the stock. It goes down below the 50 on this day on high volume. Notice the volume is 33% higher than normal. You could see that with the little skyscraper sticking up above the red line. Okay, so now it's living below the 50-day moving average this week. That's not good. If a stock lives below the 50-day moving average for too long, you probably want to get rid of it. But now we're down below the 50-day moving average, but look what happened. On high volume, we gap back above the 50-day moving average. So now we're back in the healthy zone again, but one day does not make a trend. And so what did it do the next day? Well, it held that level pretty close, right? And now we got low volume as it messes around, a high volume bar again below the 50-day moving average, but it saved it the next day. So that's why you got to have these confirming days. So it saved it the next day. The 821 went positive again. Remember that I said that. And then the stock had this high volume bar, right? Notice it's 56% above average moving volume, 259 million shares. A lot of shares, okay? A lot of shares. And then the stock couldn't break out. It, like the next day it went down. Maybe the market went down. Maybe the sector went down. Maybe just the stock went down because it was failing here. Third time trying to break out, okay? So it didn't have a breakout, so you can't say it's a fail, but it's going down and testing the 50-day moving average. Each day it came and saved the 50-day moving average, okay? Pretty decent volume, the first day for sure, the next one not so much. Then we had a gap up here on good volume. Now, not great volume, just 11% good volume, okay? The next day, though, 35% above average daily volume, and this is through the breakout. But remember, you want to have 40% above average daily moving volume, 50-day average moving volume, whatever. You want to have at least 40% if you can to get strength behind it, because that's what the market makers are doing. They're buying, right? And so you've got that strength coming in here, but it's not huge strength. It's a little bit of strength, right? Notice here it's minus 1%. And here it's, 35%. It's not 40. And so we had a failure of that breakout. 40% of all breakouts fail. So here's a failure. And then we had that, we had a gap up, okay, this day here, where it went to 195.62. 195.30. We gapped up on only 4% volume. Not a huge amount of volume. And then the next day, look what happened. We had 52% higher than average volume. So we had a big failure candle there. And now it's back inside that consolidation level, right? Remember, this is our breakout area, right? Now it's back underneath that. I know it seems weird to be talking about this all the time, but this is how you have to analyze charts day by day, but after looking at the weekly to take out the noise. So now we're below and then we go above. So now we're porpoising back and forth above and below the breakout point, okay? And now we're back below the breakout point. We make basically another little consolidation in here. You see that? Goes all the way down to 176.76. Still pretty healthy, right? Notice how the relative strength line is still moving higher. It's not breaking down, okay? And so we take another shot at a breakout here on good volume. Well, this day is not good volume. Is this day good volume? Yes, this day is the good volume. So we break out, actually we break away from the breakout spot. There's a breakout zone that's 0 to 5% away from the pivot, and that's where you want to buy your stock for the high probability. Well, this one gapped away from it on good volume. 64%. Huge. But if you bought it there, you'd be chasing it. So don't be buying after the 5% buy zone. Okay. And so you're going to see the stock gaps up again on good volume. In fact, this is the highest volume since all the way back in here, this volume bar, right? And then it makes a high. It closes down below the 50% mark on that candle. It can't hold the high. It fills the gap. I do a whole thing on gap analysis. So if you want to study gap analysis, I have a whole video on that or more. And then it fills the gap and then immediately goes back up and sees, hey, can I get back up to the 212.19? Well, it kind of couldn't, right? It got to 211.34, couldn't quite make it all the way back up. Notice the volume wasn't enough to carry it, and then the stock starts to fail, right? And it fails, and it goes right back down to its pivot. It goes right back down near its support level, and it bounces back up at the end of the day, and then the next day we have a gap up on okay volume, only 9%. Well, that's important because it couldn't hold that anymore. And now the stock is going back down. See, the lower volume means there's not a lot of conviction. But I think it's coming back the other side. I don't know, but this one is in a stage 2 to back up. I think it's taken 2 or 3 shots to break out from its pivot point. It's a nice little flat base consolidation after a big consolidation. To me, we might be looking at this chart in 6 months, and I think we're going to make a third stage base. I don't know. We could be, going down the other side, and this could be a big AI bubble like everybody's talking about at the time I make this video. And so you're seeing it's kind of just hovering around this area. In fact, it's making basically a base on base pattern right in here. Now, this is a big base on base pattern. It's a little bit wonky on the bottom, but that's how I do an analysis, everybody. I look at the chart on a weekly. I try to find the bases. I want to make sure I'm in an early stage base. I analyze where my breakout spots are. I try to look for volume as it goes up. I then talk my way through the day by day of the chart. And then that paints a picture for me. So what did I walk away from at the end? Well, I think Nvidia might be going higher, but I certainly don't want to buy it until it proves that it's going higher. And I want to be able to try to buy it in that buy range, okay? Now, the market's red as I record this video, so I don't have a lot of confidence that I'm going to be buying this stock as long as it's red, because now I've got 70% of the market going against me. I have to be really, really right, okay? How's my relative strength on this? Well, it's falling a little bit. So the picture for me is wait and see on Nvidia. But it took me 10 minutes to walk through that chart to give myself that confidence and probability, and I could be still wrong on it, but at least that's the way I do the methodology on this. Okay, so that's the process. Now, I know it took a long time to explain it to you, but really in that time, we only looked at 2 hypothetical stocks. This takes time, guys. Anything worth doing is worth doing right, so you might as well spend some time. It's your money after all. Get into it. Repeat these things out loud. Paint a picture. I know that you're going to get certainty and probabilities on your side by doing it, but it's going to take a little bit of work. Do it on every stock that you own, every stock that you want to own. Walk your way through it, read the charts, do the base count, all the other stuff that I mentioned, and I know that it's going to pay off in the long term in your investing. Take care. By the way, if you want to see how this all works, I created a free mini course for you called the 4-Step Cash Flow Blueprint. Just go to this link or the one in the description and we'll deliver it right to your email. I'll see you soon.
This content is for educational purposes only and is not financial advice.